Well, good morning, everybody. You'll see me, I'm setting a timer on my phone so that way we stay on time today when we do live events. I like to stay on track. So we are recording today's session, so we'll send it out to our membership. We'll post it on our YouTube channel. But I wanted to welcome you all here today. This is our leadership series. This is our first one in person in 2 years. It's been too long to get back together and get back in person to see everybody. So greatly appreciate everybody coming to this because this is critically important to our region specifically because we've been so impacted by the pandemic. Back in, I think it was almost a year ago to the day, the gentleman to my left participated in a virtual panel with us to discuss the economic outlook. And at that time, vaccinations just started to come about. There was a lot of optimism going forward with economic outlook, but nobody anticipated Omicron. When you talk to your hospitals, you talk to your economists, what that gave us, we're presented a whole new set of challenges for our environment. So not just as a destination, but you're looking at it as a region, as a state, as a country, as a global economy, the impact that it has had and the opportunities to come out of it and the challenges that we face. So greatly appreciate you coming with us. Stockton University is a tremendous partner of ours. The leadership series that we have will be presented by the Stockton University School of Business, so we're grateful for their partnership. This is a fantastic room. Their staff is tremendous. You can talk to their team if you need this room for anything. It's a great facility to see, as you can see with the projectors. There's even a projector on that side for us to see when we're giving presentations. But I want to introduce our panel as we get started. So to my immediate left is Dr. Richard Kasmin. Congratulations, he's recently a doctor. Richard is the chief economist for the New Jersey Economic Development Authority. He brings a wealth of knowledge and experience in economics and statistical analysis to the NJEDA and to us today. Richard spent more than 20 years as an economist and strategist in the financial investment industry, specializing in analyzing and forecasting economic activity, labor market dynamics, and inflation. Along with his work at the NJEDA, Richard is also an adjunct professor of macroeconomics at County College of Morris. Richard holds a master's degree in economics from NYU and business administration from Cornell University, and he recently received his Ph.D. in education policy from Rutgers University, where his work focused on economics of education. So, Dr. Kasmin, thank you for joining us. To my far left is Dr. Oliver Cooke, no stranger, professor here of economics at Stockton University. He teaches courses in macroeconomics, ecological economics, U.S. economic history, and political economy. Dr. Cooke has nearly 20 years of experience conducting research on metropolitan area and state economies, labor and real estate markets, and public policies. He created and authors the South Jersey Economic Review. He is currently program coordinator for Stockton's economics program and co-chairs Stockton's Economic Inequality Initiative. He also received his doctorate from the University of Massachusetts at Amherst. So Dr. Oliver, thank you. Dr. Cooke, thank you for joining us. And to my right is Eric Reich. Eric is president and founder of Reich Asset Management. He relies on his more than 20 years of experience to help clients have an enjoyable retirement. Using his enjoyable retirement solution, Eric helps retirees maximize retirement income while persevering their principal. Eric is a graduate of Richard Stockton College, Willdale University, where he earned a Bachelor's of Arts in Business Management. He has since become a certified financial planner professional, obtained his certified investment management and analyst, and earned his chartered life underwriter and chartered financial consultant designations. He is a past president of Stockton's Alumni Association and former member of the Foundation Board of Directors. He also served as co-chairman of the Cape May County Chamber of Commerce Small Business Development Committee. So thank you, sir, for joining us. One other thing, I got to get used to doing this as panelist and controlling the monitor. I didn't thank our sponsors. So I talked about Stockton University, but Reich Asset Management, Ocean Wind, which is the Orsted project, Horizon Blue Cross Blue Shield of New Jersey, Comcast, and Atlantic City Electric. Take notice, that is Atlantic City Electric's brand new logo. It's the first time I'm using it. It's a pretty sharp logo. They redesigned it, but it's a good looking logo they put together. So thank you to all of our sponsors for helping these events happen. As you can see, I went through our panelists, Dr. Cooke, Dr. Kasmin, and our good friend Eric. So we're going to jump right into some of the questions now. Let me flip my page. And I'm going to start with Oliver on this one. March of 2020, the world stopped. Across the country, consumer spending crashed. Restrictions and concerns kept people away from stores, restaurants, large gatherings, and more. We are a market that thrives on these gatherings. Enter 2022, or 2021 at the time. Vaccinations became readily available, cases and hospitalizations stayed relatively low, restrictions were lifted in the late spring, and were not put back in place even with the incredible surge of Omicron. Overall, how do you see the local economy's key hospitality sector perform in 2021?
Thank you all for having me. It's a pleasure to be back here face to face with you all. Thank the Chamber as well, Michael, for the invite. I would say that the hospitality sector, as you kind of think about what happened over the course of last year, the COVID, obviously, recession of 2020 provides a very low benchmark against which, in some sense, everything is being measured on kind of a year-on-year basis. And so if you kind of think back to the pandemic here, the local hospitality sector shed something like 14,000 jobs. It was about a 36% decline, significantly larger decline in terms of employment than what the nation saw, which was about closer to 20%. So I think it's pretty clear that hospitality and tourism, more broadly, the sector was, perhaps the hardest hit across the country, not unsurprisingly, owing to its, face-to-face nature. And then last year, there was kind of a reasonable bounce back to some extent. I mean, if you just look at the local hospitality sector's kind of job performance, regained about half of those 14,000 jobs that were lost. So, still relative to the pre-pandemic 2019 benchmark, there's a long way to go still. The gaming industry, in terms of just revenue creation, actually bounced back quite well, as most people are aware, largely on the basis of internet and sports wagering, not necessarily traditional brick and mortar kind of revenue. But kind of leave it at that, and maybe some.
Yeah, it certainly you saw this change in gaming as it's transitioning to more online with your sports gaming and everything else, and the pandemic just sped it up. Where you're starting to see that brick and mortar come back. And we're going to keep this panel discussion very conversational. So Richard or Eric, if you have anything to add, please at any time jump in. I'm going to jump to you now, Rich. We talked about the local hospitality sector. Let's move on to the regional economy. How did the regional economy fare in 2021, and how do you define the regional economy? Where is that region?
Oh, so are we talking about the county? Are we talking about, yeah. Excuse me. Well, right, so obviously the county, it does fare quite a lot by what's going on places like Atlantic City. Look, this county is highly, sourced by people who work in the entertainment, hospitality, all those types of industries, a lot of service industries. And what we saw in the pandemic was that if you're in the good sector, if you're in sectors that don't have as much face-to-face, you fared actually very well, right? So like trade coming through the Port of New Jersey is up actually 20% from where it was pre-pandemic. It's actually surged, right? So that area of the economy did very well, and a lot of areas like finance, management, technologies all did very well. Unfortunately, if you're in anything that has to do with entertainment, hospitality, those types of services, it's been a very tough pandemic, as you would expect. So I think, when we look at how the economy fared, it didn't fare very well relative to the rest of New Jersey, relative to the rest of many parts of the country. So I want to say, what's the good news? And I think the good news is that, at least from where we stand today, that the pandemic seems to be ebbing. And, I've been around a little bit over the past couple of months. It looks like people have a real desire to be out, to be back in restaurants. We certainly saw a big drop in restaurant activity around the time of Omicron. But that seems to be picking right back up. People have the wherewithal to spend. I think one of the main concerns when I look, let me continue on the positive first, actually. So the main positives I see are that, so you're going to have all that activity coming back. You have actually a lot of, I work as part of New Jersey's government there's a lot of focus on this area in terms of money and desire to rebuild this area. That's a double-edged sword. I mean, it's wonderful to have all these people and all this money coming in. It's your job as business people to make sure that you keep on those public sector servants and make sure that they use that money as you see fit, because they're not very good at that, quite honestly. So you want to make sure you're on them, because there is going to be a lot of money. There's going to be a lot of desire to have policies enacted here that help you, and you want to make sure that they do it right. The tough part of it is that the labor market has become incredibly tight. And we have a high unemployment rate here in in this area, in Atlantic County. And part of it is that I think desire to work, desire to be places, desire to work has fallen. And it could take some time, for people to want to come back to those service industries that we really rely on them for, especially like this area. Look, there's high inflation right now. That's a concern. That's also a double-edged sword, because, people who thought, well, I can just get through now and I don't have to work as much. I've got some government money coming in, so I can just sit on the sidelines. Inflation's eating away a lot of that. So I do think that people will come back and want to work again and be in the service sector. There's a lot of positives of working in the service sector. But right now, there is a bit of a supply problem. So even as the economy does hopefully start to roar back in areas like this, it might be tough still to hire the people that you need in some of those face-to-face service sector areas. So it's a transition. There's going to be a period of transition, I think. But just bottom line is, the good news is that hopefully we're at the tail end of this pandemic. People have a desire to be out and spend again and live their lives again. They should come back to places like this. There's a lot. I mean, I haven't been down here in a while, and every time I'm down here, there's so much change going on here, and it's wonderful, right? I mean, there's certainly a lot of investment, desire to make this place work. There was a lot of things going on here before the pandemic. Hopefully they'll pick up again. So there's a lot of positives, but it's certainly been a rough pandemic for this area.
Yeah, definitely. We're a market that thrives on crowds.
Yeah.
When you look at the entertainment industry, you look at your casino floors, you look at the convention business and what that means to our destination, certainly during the shoulder seasons. And that is a complete halt, and that's gradually coming back. You're seeing, it's a risk and reward is what you're seeing from the entertainment industry. And for the people that don't know, I spent 9 years at Boardwalk Hall in the Atlantic City Convention Center working with large scale events. I'm also the director for the Atlantic City Air Show. So I've got some real event experience. But when you talk to event planners and event managers and what they're going through right now and how much that impacts our market, it's a real struggle for anything indoors. Your convention business, your league of municipalities, the teachers convention, there was already a decline happening already with some of those events, but they're declining even faster now. So it's going to take time to bring them back. But your concerts are selling out because there's not as much product that's out on the market. Tool was in Philly, sell out. There's a lot of these major concerts. You look at your professional sporting events, your Sixers games, your Flyers games, they're all selling out. So it's risk and reward, and it's based on interest, but it's good to start seeing people feel a lot more comfortable going into those environments and starting to see the restrictions ease as Philadelphia just took away the vaccine mandate to go to games at the Wells Fargo Center. So you're starting to gradually see this change, and hopefully it continues through the summer as numbers have stayed low. We'll see what the fall brings. But anything to add to?
No, I'll jump in a little while.
Yeah.
These couple are for
yeah,
colleagues.
Because then we're looking at the regional economy now. Oliver, jumping back to you, the state, the nation. What do you see across that for 2021 as compared to the local economy and the regional economy?
So last year, the local economy, and here I'm just largely referring to Atlantic City, kind of the metropolitan area, which is coincident with the county. The job growth actually outpaced what happened at both the state and the national level. Now, again, that was largely owing to the fact that in 2020, the local area economy underperformed so widely. So that's not necessarily saying very, very much, in terms of the bounce back. But But picking up on what what Richard said, I do think that to the extent that there's still a very important part of the kind of local economy here that's very much tied to hospitality, obviously, admittedly far less even going back a decade than it used to be, as the local economy has kind of diversified. That slow walk back towards something that is going to presumably resemble something closer to pre-pandemic normalcy, which I don't know if we'll ever get there, but assuming that we continue to kind of slow walk back towards that, I think that generally bodes pretty well for the local economy. And so, like looking out over 2022, which I know we're going to get to, I think that the hospitality sector is going to probably find its footing. There's obviously some issues on the supply side as they relate to labor. There's this larger elephant, I think, that's hanging around in the local economy, especially as it relates to New York City gaming, which perhaps we can talk about a little bit later, which is a whole different ball of wax. But overall, last year, kind of strictly speaking, just in terms of like what happened to the local economy, I think it actually performed reasonably well, but again, that was on a relatively low base the prior year, which was as Richard said, was very tough for the local economy.
Yeah, and then something we touched on a little bit earlier was really the inflation.
Mm-hmm. Yeah.
It is incredible what we're seeing. So, Rich, jumping back to you as we touched on this before, what's caused this jump in inflation? What's the likelihood? How do we get out of this?
Right. So inflation is one of the tougher things to see coming in a lot of ways, right? So what we had was a huge hole in the economy, and in order to fill that hole, the government threw a ton of money at it, and it was rightfully so. They probably overdid it in terms of keeping the tap running into 2021, sending people checks, all that kind of stuff. So that probably was overdone. We also have there's an overplaying of the supply issues, right? So the ports are gummed up. Like I said before, this trade coming through the port of New Jersey is up 20%. We're not dealing with major supply constraint problems. We're dealing with demand that was so strong for goods, and not only here, but globally. And absolutely, there have been some supply constraints. So strong demand, well, some caps on supply. You get back to Eco 101, that's going to cause rising prices. You're also starting to see it in wages too. So now we have a tight labor market. People realize that. They're bidding up in different ways their wages. So either they're leaving jobs, and people are overplaying the quit rate, the idea that people are just leaving jobs all the time to get new jobs. That's happening, but it's not necessarily happening any more than it did before. There's actually just some, a little bit of a wage cycle going on here. So all these things raise inflation. And on top of that, we have rising oil prices. We also eat in food. So there's a lot, costs are pushing up inflation, demand is pulling higher inflation, and the Fed got it wrong, right? So the Federal Reserve has left policy way too easy, throwing way too much money into the system for too long, and all these things cause inflation. And so when we look at it now, it's, what's the risk? Can we get inflation back down? Yes, we can. Easily in a lot of ways. It is really just a matter of how quickly the Federal Reserve is going to react, how much they're going to raise interest rates. The risk there is that it slows the economy, right? So even now, without ever really even pushing a button, essentially, if you're on the Fed, to raise interest rates, just their talk and everything has already caused interest rates to rise. And so that's going to slow the economy. It's going to hit the housing market somewhat. That's going to hit investment somewhat. But it's still well below the rate of where it needs to be. So the Fed will probably have to do a decent amount of tightening in order to slow inflation. And inflation, we still have this dynamic where I think inflation will probably be higher than the Federal Reserve would like it for a considerable amount of time. So they really are probably going to have to raise rates a lot more in order to slow inflation, unless and there's always all these different areas that economists talk about, unless it really is transitory, and I just don't believe it. I don't think that it was just all because of supply problems and inflation will just come back down. So now, does it cause a recession? In the past, it's been tough to really slow inflation without causing a recession. That's basically the experiences that we've seen. There's not that many of them here in the United States, but we look at, okay, we have high inflation, what does it take to get it back down? It causes expectations of inflation to really be tamped down. It causes this wage spiral to really slow, and to do all those things, you really need to slow the economy, and then you do risk recession. So the good news is that there's a lot of desire to invest, a lot of desire to grow, a lot of desire to hire. So I think that when I look at it, my base case is not that the Fed will hike so much that it causes a recession. I think we'll skirt it. I think that we'll have slower growth, but I think we'll skirt it. I think that it'll take some time to get inflation down, but I think we'll be able to do it.
I think it's a great example of these things don't happen in a vacuum, right? So we can't just print money, we can't just give out stimulus money, and again, it's great when we get a stimulus check, but the reality is this was a total failure on both the administration and the Fed's part, because you can't just keep printing money and think you're not going to have repercussions for it. You're also doing that, you're creating artificial demand at a time when we have supply chain constraints, so now it's the worst of both worlds. And that's why we're seeing the pricing, that we have now. So I think that's definitely going to be an issue. The Fed is really going to be key right now. I think the Fed is finally waking up, but the question is how fast? Because if the Fed moves interest rates too fast, what you're going to have is you're going to create an inversion of the yield curve. So which means your 2-year, your short-term rate is going to exceed, your longer-term rate. And an inverted yield curve is one of the 4 classic signs of a looming recession, which typically happens somewhere in that 8 to 9 month period afterwards. So I'd love to think we could avoid a recession, but I'm not totally sold on it, because the Fed has dropped the ball so bad on this that I can't imagine they're suddenly going to get it right going forward. Maybe they do, but I am not remotely confident that that's going to happen. And the problem is, while the Fed's going to want to raise interest rates at a modest pace, the reality is they're going to do what they have to do. And we can't see food prices, fuel prices, all the other prices that we see skyrocket without them taking more aggressive action. So I personally think that first interest rate is going to be higher than normal. It would not surprise me it was 0.5%. Normally that was never even on the table, but it wouldn't surprise me. And I think we could see, we've heard from 3 to 6 hikes in a year. I think 6 maybe is a little extreme. I think that's overdone. But 3-4 hikes this year is absolutely reasonable, and I'd expect one of them to probably be 0.5%. And it's going to slow down the market, obviously, because it's going to slow down spending. And if it slows down spending, then the rest of the economy kind of goes with it. So, be interesting to see.
Yes, it will. And Eric, I'm going to stick with you on this, because it's something we talked about. I've talked to a number of you about this in the room before, certainly at chamber meetings. This surging demand and shrinking supply in some areas make home buying more difficult as affordability worsens. It's almost out of reach for many people in the middle class now. So what impact will inflation have on the economy and the markets? In the economy and the markets, yep.
So, I think it's going to, and I think we'll touch on this a little bit, housing is obviously going to be a big one. But clearly inflationary environment, it's going to slow the markets a little bit. We know that's going to happen. It's going to have a bigger impact on the bond markets than it is on the stock markets. And a lot of people are kind of worried about the stock market because it's been a little volatile lately. But I'd be a lot more worried about the bond market than I would be the stock market. If there's a bubble that exists right now, it is in the bond market. Bonds have averaged about 3.5% for the last 150 years. Since the early 80s, around October of 82, give or take, we've averaged 7.5%. And we've come to think that's normal, and it's not. And it's what they call a reversion to the mean product. So basically, if it's been too high for too long, it's going to overcompensate to average that 3.5% number. So I would expect for the next decade, give or take, maybe a little less, probably a zero real return in bonds. I don't see bonds returning anything net of inflation, because I agree with you, Rich, on the transitory nature of inflation. I hear that a lot, and they say, once the supply chain's fixed, it's gone. That is not remotely true. I think inflation is 3 to 5 years, is my estimate, I guess, at this point. So we're going to see inflation for an extended time period. And if we do that, if I'm making 3 or 4% of my bonds and I'm losing 3 or 4% to inflation, that's a 0% real return. So I would expect we're going to see that for 5 or 10 years. So as much as the volatility of the stock market scares me a little, it's better than the alternative because I think the bond market is really the thing we have to worry about.
And I gave an intro to some of this. We started talking about the housing market. We certainly see it here. I think there are 70 homes listed between Ventnor, Margate, and Longport on the island, but Atlantic City, Elizabeth, you and I talk about this all the time, how many properties are listed in Atlantic City. So you're seeing this enormous reach for supply and a very, very limited demand. I had a friend of mine just list a house the other day. It was on the market for 4 days. He had 29 people come through it, and 5 people got into a bidding war for it. 4 days. Incredible. Yep. So this is what we're dealing with. But what do you think the housing market, Eric, I'm going to stick with you on this. What do you think the housing market looks like moving forward?
Well, I think you still have cash buyers. So until the cash buyers are gone, then it should stay fairly strong. Plus, in an inflationary environment, people like hard assets. Real estate's a hard asset, the commodities, real estate, things like that. So they want physical asset. So that's going to help for the near term, that 12, 18, maybe even 24-month time period. But at some point, if we're mortgage people, and we're taking, which the vast majority of us are, if interest rates move up 2-3%, and right now I could afford a $500,000 house or something. Well, when interest rates go up, that house is suddenly going to have to be $400,000 for me to have the same mortgage price or the same mortgage payment. It's going to happen. So we are going to see a drop in the housing market. The only thing right now that's preventing that is that there's no supply. So until supply returns to the market, which again could take 1-2 years, or it could even take longer, I guess. But I think you're going to have a lot of fear of missing out. I think a lot of the people who've been sitting on the sidelines, not putting their house up because prices just keep spiraling higher, are going to realize, ooh, I better get in now. And I think you will see probably in the next 12 months a flood of supply, not massive flood of supply, but dramatically more supply start to move into the markets. And then that's when you're going to see your shift. And, contrary to the last 2 years, prices are going to come down. It's going to happen.
Yeah, for sure.
Yeah. I just also want to add, when we look at these markets, we look at the stock market, the bond market, the housing market, we have a tendency, as economists to look at history and pinpoints and say, okay, this is what the housing market did when interest rates rose, and this is what stock markets did and bond markets and all these things. And I always think what we tend to not be able to understand, because it's very hard, it's what were the behavioral dynamics, or what were the thought processes going on at that time in the 1970s, 1980s, 1990s, whatever you look at. And so when someone was buying a house in 1972 or something like that, and the house was like $30,000 and the interest rate was 15%. Did that person have an idea that, the inflation was going to be 10% for a decade, and then interest rates were going to drop from 15% to 4%. So, I can easily afford this $35,000 house. Absolutely not, right? Nobody knows anything like that. So, so when we look at the housing market today, what do we know? The only thing we know is what's in front of us right now, and which is that there's been a lot of changes in behaviors. So people are staying put a lot more, and we have this aging population in New Jersey. People want to get out of here. That's absolutely been true for a long time in terms of retirement, and it's still happening. But that the supply is just dead, right? No one's going anywhere in terms of like, not that nobody's going anywhere, but supply has just not come back. And we have a lot of demand seemingly coming from some of the urban areas, from the city, I suppose. It's still been happening. I think they overplayed that probably, but we just had just a lack of supply. And absolutely, when you have inflation, hard assets are great. We have what's the mortgage right now? I don't know exactly where it is. It's still sub 4, I think.
Oh, yeah.
What's that?
Yeah, that's about right.
And okay, well, wages are at least keeping up with that. Labor market looks pretty strong. Labor market looks pretty strong around here in New Jersey. So you still have to feel pretty good about buying a house, but you don't know what the future is going to bring. Well, I'd like to start a family. People put off starting families for a long time, even with the pandemic. We do have that generation finally starting to what people thought was like, oh, they're finally growing up. They finally want houses. Okay, maybe people are definitely looking to New Jersey more and buying houses, and the interest rate is still attractive. And so the housing market still looks, there is a complete lack of supply, but in terms of demand, it still looks pretty solid. Houses go quickly. But and then you look at bonds and stocks. Bonds, yes, absolutely. They're in terms of inflation, they're a loss, right? I mean, who the heck would want to buy a bond? Well, somebody does, because the yield wouldn't be here if there wasn't supply and demand there. And so it's complicated because it's not just people, there's whole banking, financial systems that operate off of bonds like money, right? Bonds play a role in the liquidity of the financial system. And at least you get your money back, so bonds have an allure even though they're a loss in terms of inflation. And then stocks, they've been highly inflated, but people think that we're in this very dynamic economy right now where there's a lot of potential for growth in terms of innovation and all these things. And you're looking at a stock price and you're looking at some of these, especially some of the tech companies have PEs that are 100 plus. And you're like, what kind of moron would buy this? Well, someone is, right? So the point being is you never kind of know. All the thing you know is what's in front of you right now, and you make your best guess as to where you want to put your money, what makes sense for you, what's your horizon, what's all those things. Is it the right time for me to buy a house? Yeah or no, who knows, right? I mean, it's there's so many factors that go into people's minds. What we know about the things that are going on right now is that we have a very tight very tight housing market. It's hard to buy a house. People want to buy a house. Nobody's really putting their house on the market because everyone wants to stay put. Will that change? Maybe as the pandemic slows and we get back to some idea of normal, more supply will come on, and that'll help. That's also a good thing. I mean, right? So it's okay, people flowing around, that would be great. But there's so many factors right now that we haven't seen historically to understand what's the right price for stocks and bonds and houses and all these things. It makes it very difficult, I think, as a forecaster. And the best thing to do is know as much about your life as you can and think about your sort of future and what you can afford and what you can't. And it's a very tough environment, I just think, as a forecaster.
Incredibly. And if you're not sure, you work with a financial
yes.
planner, correct? To get expert guidance. I mean, I did a little bit of that outside of college. I know a fraction of that with my Series 6, but there's a lot that goes into it, and pandemics make it even more challenging. But I think now, we touched on this earlier, and obviously it's an enormous issue here, the labor market. The labor market, what we saw on the workforce front is really a significant shift in demand. More health professionals, you're seeing people switch into STEM careers. Proportionately, you're seeing fewer food servers, you're seeing production, customer service, office support workers, all declining. Even and I never thought we would ever see this, the talent pipeline for teachers isn't there anymore. So that's diminishing. So in a region that relies so heavily on hospitality, what is the outlook for regional labor supply in 2022? And Richard, I'm going to stick with you on this one as you were touching on the labor market, but that's an enormous issue here in
Right.
Atlantic County, enormous.
Right, right. So, you know, the labor supply issues aren't just here, they're nationwide. So what we've seen is that as the economy has come back in, and actually, you know, the level of economic activity in a lot of ways is back right on path to where you would have been had there not been a pandemic. But we have much less supply of labor. And so why don't we have as much supply of labor? Well, the desire to work has gone down in some ways. So, you know, I was just looking at a paper that came out the last couple of days that showed that it's not just about people who have dropped out of the labor force. And so you have like early retirees because they're just like, I can't take it anymore, I've had it, and I just want to be able to live my life. And life is short, right? So like, you know, you think about, okay, what are the incentives in a person's mind? Oh, well, I'm going to live to be 85, so I got to work until I'm 65, and then I'll have enough savings and I can live for that. And all of a sudden people's like, hey, life is short. I don't know, I could die tomorrow because of this pandemic. I'm out of here, right? And so people like leave their jobs quicker, and so that's a real thing, right? But it's not just that, it's actually people are working less. So this paper looked at not just people leaving the labor force, but the hours that people are putting in has dropped because people want to spend more time doing the things that they care about outside of work. So there's multiple ways that labor supply has shrunk. Now, the question is, will it come back? Like, will people's desire to work come back now as the pandemic starts to ease? Inflation, in some ways, is actually a benefit to labor supply because it's making it more costly to not be working. So, you know, your health and your lifestyle are really important, but also is your ability to afford the life that you have in your mind. And so all of a sudden, people might be saying, I really wish I hadn't left. I can't afford it. Inflation's 10%, I'm going to the supermarket, and milk is, you know, $4, and tomorrow it's going to be $4.50, right? So all of a sudden I think that'll impact people. And as they see more people coming back into the labor market, I think they'll also feel like, I got to get on that train. So I do think that there's incentives to come back into the labor market, and labor supply will pick up. But it'll probably be with higher wages. It'll probably be with more flexibility in terms of people's lives. Like, work will have to be more amenable to people, right? And one of the so I studied education, so teachers leaving. It makes perfect sense to me. I spent enough time in school cafeterias to know it is not fun. And these teachers, I mean, it's like, it's ridiculous. Okay, they went into this job thinking, this is going to be great. I'm going to get to change kids' lives. I'm going to make a difference, and all they get is principals on top of them, checking lists to make sure that they've spent this much time doing this, and that the tests get these marks, and it's the worst job. I mean, and it shouldn't be. Other countries do education so much better because it's an environment where teachers collaborate, they learn from each other. It's not just all about, I've checked boxes and I'm in charge of 30 kids all by myself. The job stinks. And so in order for labor supply to improve, we need to treat work and jobs not just a matter of someone higher up checking that you've done everything that you need to do and you're not allowed to leave or until you've done the things. It needs to be a more collaborative process. So I do think those kind of things will come out of the pandemic because I think labor's having a movement. And so if we want teachers, if we want these people to come back, if we want service people to come back, those things will happen, and the incentives are there for, I think, the schools and entertainment and all these other industries to make it a better environment for workers. So I'm optimistic that labor supply will come back once those things start to happen.
Well, that's a good thing, right? I mean, I think it's important as an employer. Like, for me, it's not just I pay you to come here Monday to Friday, 9 to 5. It's I want you to have a great experience as an employee in my company. I want you to really feel fulfilled in what you do. And we try to really survey our employees to say, hey, what do you want? What do you want? What are the things about your job you like doing? There's always something you don't love doing, but what's meaningful to you? What do you find? And I think that's a great movement in America. I think Europe's had that for 50 years, and we're just getting there now. But I think it's really important that employees do have a say in what their job's like. And okay, maybe you're not working from home, 4 hours a day, but you have to have some type of buy-in on this is what matters to employees. And employers have to recognize that, and they need to be flexible in that, helping them achieve their goals. They're not just trying to help you achieve yours.
Yeah, I think that there's, as it relates to labor supply in particular, there's a variety of ways that the economy adjusts. And I mean, one of the things that we oftentimes, I think, when we start talking about, there's this collapse in labor supply and there's been all of this, ink spilled over the last 6 to 9 months over the so-called Great Resignation and all of these things. Wages are a price, and prices go up and down for a reason, and as they go up, it's a signal that's effectively being sent to the world that, there's a resource shortage, right, in these kinds of situations. And so to Richard's point, well, if there's a teacher shortage, then obviously prices for teachers are going to rise if you're going to induce people to actually go into a classroom and do that job. And so these things take time to work themselves out. It can't possibly happen overnight. But if you kind of think writ large about over the course of the last year or so, the national labor supply is only about 0.5 point down from what it was pre-pandemic. In the state, it's about 3.2, and locally it's about 3.2. In the state, it's just right at 3, down. So I expect, as these shakeouts, as Richard is suggesting, people, had a huge, life-altering event that we've all, lived through. And I don't think it's terribly hard to understand that people had a rethink, and many of them have decided they're going to change directions and change careers for all sorts of different reasons. And I expect as we move out, especially locally, I think that the labor supply will adjust and kind of move back in the general direction that we've seen it start to move at the national level. I know the Fed is very kind of mindful of what's going on with the participation rate, but the participation rate is slowly ebbing back up, to where it was. I mean, we're not quite there yet, and maybe we won't get back, but the economy has proven pretty resilient, right? I mean, this unbelievable event, that created this very strange, effectively 2 to 3 month recession. And, almost in a matter of months, the economy, the ingenuity of how economic agents behave is really remarkable in many ways. So, I tend to be maybe a little bit more sanguine than, as I kind of think about these shocks, and kind of looking out. They're certainly important, and I can see how local businesses, right? My own family has small businesses, and it means, input pressures, right, are going to be, input costs are rising. But, that's the way the system is supposed to work, in some sense. Yeah. So, to Eric's point, these are good things, right, at the end of the day. It doesn't mean that the disruptions aren't inconvenient while they're happening. That's for sure the case, always.
Yeah, I also just wanted to point out on top of those points is that, when we talk about labor supply, it's not one thing, right? We can talk about it by race and ethnicity, we can talk about age, we can talk about it by skill area, right? So what we've seen in the pandemic is if you're highly skilled, it's the greatest economy you've ever seen, right? It's like your wages are going up, people are bidding for you. Couldn't have been better. If you're lower skilled, your unemployment rate shot up. You got money from the federal government for a while to keep you at a subsistence level, maybe even better, right? So actually what we saw was somewhat uncommonly was poverty rates actually plummeted because of the child tax credit, that money actually going into people's pockets on a monthly basis. Substantial amount of money, like $500 a month. We saw 3 rounds of checks from the federal government, I believe, going to households. Moratorium on payments for rent, things like that. So it was a boon in terms of your ability to survive, but those things are dropping off now. So So labor supply, right? It's a double-edged sword in terms of, I love double-edged swords, in terms of there were incentives to not work for some period of time, and I don't want to put a negative connotation on that. It's just, the reality was that you didn't have to have your crappy job for a while because you got money from the federal government to keep you, as you should have, given everything going on, at a subsistence level at least. Those are falling off. People are going to come back into the labor supply looking for jobs because you can't survive like that anymore. So there are reasons that like some of the lower end, sort of like less educated jobs, that supply is going to come back. The people who retired early, like I was saying before, I think a lot of those people will probably come back because inflation. Another real positive that we see is a lot of dynamism, right? So entrepreneurial spirit. We've seen a tremendous rise in the amount of like what we look at as applications to start new businesses. So it's not that people are also just looking, all right, I'm ready to go back to my, my FedEx delivery job or whatever it is. People are actually saying, hey, I could start my own business, and who knows where that goes. And actually, by race and ethnicity, we actually see African American and blacks and Hispanic people starting businesses at a higher, the increase has been faster than the rest of New Jersey. So just according just to some micro data that I've looked at. So that's a real positive. I mean, I think that that we want that entrepreneurial spirit in areas that, really could benefit from it. And, so people who have been on the short end of the stick in terms of labor market returns, seeing that this might be a time for them to get some real wealth gains and some business creation and all that's another positive I think that's come out of this, is that people have been sort of jolted into thinking, well, how can I do better for myself, and I'm not just going to wait around for the old economy to come back. So there are some positives that come out of what's been a real negative sort of supply and demand shock.
Yeah, I know a number of people that were kind of stuck in their job. They didn't know what to do, but they had an idea, they had a concept, and they took a calculated risk and started their own business. And it's growing and growing because a lot of it's e-commerce or it's online, and kind of looked at the situation and where everything was trending and took a shot. Pretty interesting to see that kind of growth and that entrepreneurial spirit that we're seeing all over. So it's good stuff. Going to jump ahead to the next question. We've got about 10, 12 minutes left, so I want to jump ahead to this next one. This is interesting. I'm going to go back to Eric on this one. What are the effect? You're talking about adding this massive amount of, we've been talking about it all morning, about this unbelievable amount of money, but it's added to the national debt. So what kind of effect has that happened on, since the pandemic started? Because it's a lot of money.
That's my kid's problem. So yeah, it's not great. But I always keep, because I get that a lot. I mean, clients come in and say, we are pumping up the debt to ridiculous numbers. The debt has been manageable because of interest rates, because the debt service, when the interest rates are low, it's not that hard to do. When interest rates start to rise, that's going to be a little different story. But in my world, I look at debt in relation to GDP, because that's kind of how you have to look at it, right? So when you look at our debt, it is massive, but our economy is massive. Yeah. So then if you compare it to GDP as a percentage, it's not that high relative to a lot of other countries. It's high, certainly. It's too high in my opinion, but other countries have much higher debt to GDP ratio. So while it's not good, it's not the end of the world. But again, with interest rates, I think we have to start unwinding that. I think we've got to start, and there's a lot of talk, obviously, in the Fed and unwinding some of the stuff they did. But it isn't great. It can be a future burden. It will likely be a future burden. But in context, it's not unprecedented. Let's put it that way.
Any thoughts?
Yeah, I kind of echo the sentiment. I realize that, if you kind of add up the 3 rounds of, I think there were 2 before Trump left office, stimulus rounds, and then another one added by Biden early in his tenure. So 3 different rounds of chunks of money totaling somewhere in the tune of around $6 trillion. It was an unprecedented amount of fiscal stimulus, took the national debt, up to, $29-30 trillion or whatever it is at this point. But Eric's right. I mean, you kind of, have to step back and place it in the context of a much larger economy. So it's obviously, a U.S. economy that's about $21 trillion. So, it's obviously north of 100%. But, the reality is that it's, the issuance of debt, there's 2 sides of the ledger, right? I mean, it's a debt, and it's a liability for Uncle Sam, but it's an asset for millions of other folks around the world, right? I mean, they are holding an asset that actually allows them to earn interest, right? Unlike cash, if you're sitting on cash. So, it's, there's that important kind of aspect to it. I mean, if you think of financial assets as part of the nation's wealth, roughly 70% of the national debt is held internally, roughly, maybe more these days actually, owing to the Fed's recent activities over the last couple of years. This is part of the nation's wealth, and it's kind of when we teach this to students, you say, well, it's money that we owe to ourselves, and people are like, what are you talking about? But it's true. It's money that we owe to ourselves. That's how it works. And it's, instead of allowing folks to, sit on cash, effectively, as the federal government creates money and spends money into the economy, that represents money that's in the private sector, right? I mean, that's the way that it works. A lot of us kind of think that at the end of the day, they have to tax and borrow before they spend. It's not really the way that it works. They spend, and then they decide to tax and borrow, right? It's the exact opposite. It's not like the federal government sits around and waits for you to send in your tax payment, obviously, right? I mean, they spend the money because they're a currency issue, right? They have a monopoly. They can print as much money as they want. They're never going to run out of money, right? And they can always print more if they want. So I don't know. The national debt. I agree with Eric. I think that it's going to probably start to come down, right? I think there's already, clear congressional leanings in that general direction. But I think that you can certainly find lots of historical evidence that suggests, having a debt to GDP ratio of, 2, 3. I mean, these are not, the sky has not fallen on Japan as far as I know. And they certainly have a very, very high and elevated, and have for 3+ decades, debt to GDP ratio, significantly larger than what we're looking at now. So,
and not to pile on, the only risk I think of the debt to GDP is that the government does restrain its spending because they're worried about something like that. Yeah. So we need obviously tremendous amount of investment in this country and infrastructure and all that. Now we've just passed infrastructure bill.
Correct.
But those are the kind of things where you'd hate to see, somebody in Congress says debt to GDP is too high, so we can't spend on the things that would actually really benefit the country in terms of investment. So I think those are the main risks when we think about the debt to GDP, is that how it restrains behaviors.
It becomes a rationale for austerity.
Yeah.
Yeah, exactly.
And other countries, their GDP is made up of different things. Like consumer spending is our GDP, for all intents and purposes. We're 70, 5+% of our GDP is consumer spending. So pumping that money into the economy is not the worst thing. If you're Russia, where 89% or whatever the number is of your GDP is oil, you are going to live and die by oil. In Saudi Arabia, it's 98%. So those countries are affected differently than we are by some of the other things. So because consumer spending is our main driver of GDP, pumping that money out into the world, like Oliver said, it's not the worst thing you could do, because all you're doing is keeping that economic engine running.
I mean, one of the things, if you kind of think about, back to the inflation story, right? As people think, okay, the federal government has been out, $6 trillion have been spent in addition to all of the additional liquidity, that the Fed has actually provided, independent of the federal fiscal stimulus. I mean, probably the most direct and efficient way to actually kind of begin to quash the inflationary pressures in the economy. The Fed's attempt to raise rates does this very indirectly in some sense. If people were genuinely honest about inflation, The easiest and most direct means of actually quashing inflation almost overnight out of the economy would be to raise taxes tomorrow. That could be done at a stroke of a pen by Congress. So if they're really genuinely serious and worried about, inflation getting out of control, well then raise taxes, right? And my guess is not a lot of people are signing up for that. So, the point is like, how genuine are you about the concern, right? Because you know what I'm saying?
Yeah.
I mean, it's...
Yeah, no,
we're
everybody
willing
can
to raise
just
taxes
point.
to like
you can
quash
just-
the inflation out of the economy because we could do it like this,
Yeah, no,
right?
you can point at the Fed and
And I mean, the Fed will do it indirectly, right? Raising rates, trying to calibrate the best it can, but
It's generally been a job that's been left to the Fed.
It's like Social Security. If they want to solve the Social Security problem, it takes 5
course.
minutes.
Yeah.
Obviously, they're not too worried about it, or,
No,
or,
it's a-
Maybe we
They
could work on a
would've fixed it by
resolution and send it over to them.
Yeah.
So we just solved everything. I'm going to skip the next one. We're going to have one more question because I always like giving time back to everybody, and I want to make sure that we touch on this. But Oliver, I'm going to jump back to you. The outlook for 2022. What are your expectations? What are you seeing? What are you hearing?
my sense is that I think the regional economy basically gets back into closer alignment with the state and the national trend is the bottom line for me. I really think after kind of lagging, obviously, during, taking a much larger hit during the COVID recession of 2020, starting to rebound last year, I do think locally, the labor supply story is an important piece of the puzzle. But I do think, generally speaking, to the extent that consumer spending continues to kind of grind along, and I do think that we still got a long runway of a lot of pent-up savings and fiscal stimulus kind of pumping through the system, at least over the next 6 to 9 months, maybe. I think that's helpful to the regional economy moving out into 2022. Now, beyond, moving into the next year, again, I think there are some bigger questions, especially as they relate to the gaming industry.
Yeah. Anything, you talked earlier a little bit about the infrastructure money and everything that's coming out, impacting the local money. How do you see that impacting 2022 with this bill being passed?
Yeah, I mean, there's still a ton of federal, state money that's going to be coming through for a while, and is definitely targeted on Atlantic County. And, so when I'm in discussions with people at the state, they fully understand how this area has lagged and are very focused on this being a stronger economy. And look, I mean, the investments are coming also in terms of energy infrastructure, right? So there's also a desire, I think, to see more diversification, because a more diversified economy is a better economy for everybody, right? So, because look, there's always going to be things that go wrong, right? I mean, we had a housing market blast in 2007. We've had other financial market issues. We've had this big service sector, sort of issue that happened because of the pandemic. And the lesson from all these things always is that, and it's like investing. It's like you don't want your money all in one thing, right? You want it to be diversified, because some things are going to do better, some things are going to do worse. In the end, you kind of get through a lot of that volatility better when you have more things to hang your hat on. So I think that there's more diversification in the economy that'll be happening continually in this area, and that's good. Lots of infrastructure money. The Fed is going to be tightening rates, and that's always the big risk, right? I think the big risk right now, I mean, unless you tell me something else about the pandemic, right? I mean, that's number one, right? So it's like, okay, as long as the pandemic is, we're at the tail end of it and people really want to be back out and about and all that, then there's lots of reason that, this economy will come roaring back. The Fed's the big risk outside of that, having to tighten more and slow the economy more because inflation just continues to be very hot. That probably continues to be the biggest risk out of everything right now. Energy prices, right? So, people have to drive here. What if oil prices are $150 a barrel tomorrow versus where they are right now because Russia invades the Ukraine and Russia's a big oil supplier, and then there's, so you have all these sort of, these cross, sort of effects going on, supply and demand. That would be a big problem, right, to this area, I think. So, there's always risks. But from where we stand right now today, if the pandemic is over, if the Fed isn't tightening too quickly, And there's lots of money coming in. There's lots of reasons to be optimistic about the recovery in this area, which has lagged and will. I think you'll see things improve here more on par with the other areas of the economy.
And I think that's important with the money, talking about the money going in. I mean, if we go back to 2008, so we had the biggest decline since the Great Depression. And we pumped a lot of money in the economy, and it took 3 years to work through that money. We pumped 4 times that amount of money in only 9 months into the economy. So that was 3 years of stimulus. This is 9 months, and it's 4 times the amount. So to that effect, it's going to take a long time for the economy to absorb that money.
Sure.
So that's a great, we don't know what that really means, but what I think it means is that's a pretty telling opportunity for the economy going forward. So it hopefully will help offset, Fed hikes and things like that, that infrastructure money and everything else. That's a pretty long tail to work its way through the economy. And it could last for years for all we know. So I think that's at least a positive sign.
So some optimism, a lot of optimism really, but some questions, some big ifs still out there. It started out as 2 weeks to flatten the curve, and here we are 2 years later, not really knowing what's going on. I mean, it's kind of incredible globally what this has done to our global economies, and certainly local, how much it's impacted. So they're the questions for our panelists. I want to open it up for questions for the audience. Does anybody have any questions? I've got a couple mics that we can get it, but if anybody has any questions for them, Janice, yes.
So you touched on a little bit when you talked about the real estate market. So I've been a realtor for 20 years. So back in early 2000s, people were paying absolutely ridiculous prices for things. The numbers were crazy. I'm sitting with people going, I wanted to say, are you nuts? But hey, I was making money, so why would I do that? But then, like you said, 2008, 9, 10, all of a sudden, the bottom fell out, and now we had a glutton of foreclosures, and you could buy things really inexpensively. And now I'm seeing again people paying ridiculous prices for real estate again. Mm-hmm. I think one of the differences is a lot of it's cash right now.
Right.
But did we learn anything back in 2008? Is that going to happen? Do you think that could happen again, or because they're paying crazy prices for things again? And
oh yeah.
Made sense to me. So.
Everything happens again, no doubt about it. Well, look, I think when you look back to that period, like 2007, right? So, which was the sort of the apex, and everything kind of collapsed up. What led to that was a financial system that was encouraging people to be able to buy things that they couldn't afford through, what were I forget the names of all these types of, you basically just had to have a pulse in order to get like 99%, right? So that was built, and it's a very long story, but through a system that encouraged through rating agencies and the financial system and all these derivative products to create bonds, to create mortgages that could never really be paid off. So that was financing, right? That was like financing, providing liquidity into a market that created a bubble. And you don't really have that today, right? Right now, where we sit here today, it's not like, oh, we've got these sort of like, just have a pulse and you can get as much financing as you want to buy any home. It is a lot of, like you said, cash, more sort of like, your staid sort of mortgage products. So I don't read what's going on today in the housing market as a matter of, well, it's just a matter of the financing that's available creating this bubble. To me, it reads less like a bubble. To me, it reads more like there's lots of buyers and there's just a limited amount of supply. And now people might be over, I also don't think that necessarily there's a huge run of people who are investors trying to just flip out. I mean, obviously that's happening more.
Yeah.
But, you know, it's not the main impetus behind the housing market. The main impetus behind the housing market, as I see it, is real buyers who want the utility of a home and maybe second homes, you know, that kind of stuff too. But it just reads very much different than what was a liquidity propped up bubble that was bound to burst at some point when the spigot turned off in terms of, you know, these financing products. And, you know, like being in a cab and listening to the cab driver tell you that, well, I own these 4 homes. And, you know, it's like, how are you going to, well, just because I'm going to flip them, right? So a bubble is basically you buy something just because the next guy over is going to buy it for more. That's not really what's going on right now. So I think it's much less that and more in terms of actual utility, desire to own these assets for yourself, and so and just a lack of supply. So if supply starts to come back, that's great for you, right? I mean, that's wonderful, right? Prices could certainly come down in that environment, but there's clearly more demand than there is supply. So yeah, so I think that's a very solid environment for the housing market.
Yeah, and I think you'll see, I do think, you know, to echo earlier comments, as rates rise, prices are definitely going to come off. I mean, I think you're going to see some froth taken out of the national housing market. Some markets are obviously, you know, more frothy than others. You know, Atlantic City has, I think, single-family home prices here are up 20% year on year. It's the 5th year in a row, 5th consecutive year home prices have risen. And it's been a much longer run in Cape May, right? Cape May is a whole different animal for obvious reasons. A lot more second home buying and vacation home buying in Cape May. But yeah, I mean, I echo the sentiment. I think it's a little bit, I mean, can you see certain markets come off quite a lot over the next couple of years as the Fed really moves in aggressively, which I think it's going to over the next 10, 12 months? Sure. But I do think balance sheets in general, credit standards, underwriting standards, unlike the run-up ahead of the Great Recession and the housing crisis, then haven't deteriorated quite to the extent that they clearly did, you know, in 2004, 5, and 6. That's my sense of it.
So as far as for this region here, what I'm seeing a lot of, I wear a couple different hats. I'm city council president in the town that I live in Summers Point, and we're seeing a lot of developers come in and they're investing a lot of money in our town, and I'm seeing it in other towns as well, and we're seeing it even in Atlantic City, people coming in with big ideas. And so I guess my question is that happening other places, or is that pretty much specific to Atlantic City or this region, or is it happening everywhere?
Well,
I find it pretty standard. I mean, certainly Cape May County, I see it a lot in Florida. I have a lot of clients in South Carolina. I see a lot down there. Pretty much the eastern seaboard, you know, I've seen it. Texas, I see it a lot, certainly, and California is just its own animal, so we don't really count California. But yeah, I mean, it seems to be
kind of
fairly pervasive. Yeah.
It's very closely tied, I think, to this comment about kind of, you know, business creation, which, you know, perhaps paradoxically, you know, kind of like, I think the rate has certainly accelerated over the last couple of years. But I think that in some sense this was just this fallout of people having a moment in their lives where many of them were like, you know, Richard's point, I'm not doing this anymore. Like I want to start my own thing, right? And so I think that the commercial lending, you know, side of things has been pretty robust over the last couple of years as well.
Yes, Elizabeth.
A couple points. First of all, I appreciate the comment that there's going to be a lot of money flowing into this area from government, and that the business community needs to be sure that money's spent wisely. And I appreciate the lead that the Chamber's taken in that regard, and would love to see you continue to do that and really advocate, you know, for the money to be spent wisely, because that hasn't Secondly, the predominance of service industry jobs has really affected the ability for people to buy homes here. It's just kept the housing quality low, which now is the reason why we have so much supply, I think, which is a great thing. Like, this is our opportunity right now in Atlantic City for people to buy here. but we have this like very low quality because of the predominance of low paying jobs. And I appreciate the comments about diversifying the economy, but it's just really, we see it a little bit with the energy, offshore wind, but there's really not many other things happening yet. So how do we change that? And I mean, obviously the goal would be to get the higher paying jobs.
Yeah, that's always, that's the question of the ages. It's like, how do certain places do better than others, right? In terms of attracting investment and, so why does one country do so well and other country doesn't do so well? Or why does one state or one region? So it's there's no silver bullet, right? In terms of, how do you attract investment? A lot of it comes down to transportation, legal, laws around protection of property and things like that. Look, I think a lot of, some of it is maybe just a way of thinking. It's like, okay, what's Atlantic City? Atlantic City is a place for casinos and entertainment. And so it takes other people to say, well, yes, and these kind of things would flourish here. And, so we have really good available land here that's near a port or whatever, and then so things start to build up. Or, hey, we have this energy infrastructure here, and now we need to manufacture things for that. So you start to build things that feed into that other industry. So they're sort of like Lego blocks. And government can play a role in terms of incentivizing people to come in. So like, for example, like the film and digital tax credit that the state has, okay? A great thing in a lot of ways because we've underinvested in those areas. We just haven't seen, it's like, okay, there's New York City, huge mecca for film and video, TV and all that. New Jersey not, okay, why? It's New York City, okay, so people want to be in New York City. But we're right across the river, and certainly we could have a strong, look at what Georgia did, right? So Georgia was nothing in terms of film and TV and digital. They threw tons of money at it, like, we want this. And they started to throw tons of money, and next thing you know, Tyler Perry comes in, sets up a huge, and so the money leads, and then other people see, hey, the state's really focused on this thing. So I can start to build off of that. So all of a sudden, those things come in. So the state, the city can take a lead in creating incentives for people to come in, and then the infrastructure and everything will follow, right? So I think that will happen with film and digital in the state, and we're already starting to see it reap benefits. But it costs something at first. And so some of it has to be that you are getting the public sector to focus on those things, to create incentives for other people to come in and build those other industries that you would like to see really thrive here. And not have all the money, because look, it's like, it's kind of a fixed game in some ways, because like the people who run the casinos and all that, they have a lot of the ear of what the public sector workers are going to do. And so a lot of the money is going to be focused there, and a lot of the policy is going to be focused there. So that's a natural thing, and that's a good thing in a lot of ways, right? You want that to be a very healthy, solid industry, but you also want to make sure that there's opportunities and money and policy to focus on those other things so that those other types of businesses do come in. But it's no just sort of one thing, right? I mean, it takes growth, time, focus, all those things for it to happen.
It's a long cycle. And your labor market, too, is key. And I think Atlantic City or Stockton, rather, plays a great role by being in Atlantic City, because the more having a college in a city like Atlantic City and getting residents specifically of Atlantic City more and more educated all the time, when you have that great labor force, that's a natural attractor, So I think that it helps the communities, it helps the school, it helps the economy. I mean, everybody wins when we have a strong local labor force. And parking a college in the middle of it, I think, was the greatest thing,
Yeah.
Ultimately, it might take a decade before you see the, you know, the full results, but that's a huge win for Atlantic City.
Yeah, it's absolutely been a blessing for the destination. I mean, there's been talks about this. I grew up here, you know, in Chelsea neighborhood right over the bridge, and there have been talks about Stockton coming to Atlantic City forever. And when they finally came, it was like, holy cow, this is a huge shift in our regional economy and what it can mean. Enormous shift. Any other
Slow and
questions?
steady, slow and
sorry.
steady wins the race.
That's right. That's
No
right.
one likes the slow, needless to say, but it's, I think that the history of transformative urban dynamics in metropolitan areas, you know, Silicon Valley was not built overnight. It was a multi-decade effort with lots of moving parts, but needless to say, you know, we all wish that it could be sped up. Easier said than done.
Yes, sir.
Just a thought in terms of the context of this forum. Could you just give a brief overview of what the Bader Field development seems to be? Because that seems to be a major focus of the mayors. And as far as any major projects or accomplishments that are in the offing, and what are the incentives that caused that, and what's it going to take to get it done? If you could shed some light on that, I think it might be helpful.
It's a proposal at this point, and it's at the city, at the state level. Their deck.
Who has to buy in? Does the state
Well,
have to buy in?
that we're waiting, actually setting up a meeting with the developers to learn more about it, because all we've seen to this point is really the deck, and it's a beautiful deck. I mean, the presentation that they put together is really incredible and very, very ambitious for what they want to do here at Bader Field. But, you know, some of the questions that we have about it is, you know, is something like that really going to work in this market? You know, you had the playground, there was a pier, luxury, high end, it's all gone. It's all gone. Why would these luxury cars and luxury homeowners come to Bader Field and the development there? The infrastructure at Bader Field does not exist for real development yet. You know, that's the initial investment. You know, it has to be raised 6 feet. There has to be water lines put in, electric. All that infrastructure has to be put in first. In my lifetime, born and raised in Atlantic City, I don't know how many plans I've seen for Bader Field, whether it's recreation or marinas or boathouses, you name it, we've seen it. None of them have happened. So our position as the chamber is to learn as much as possible and then be able to answer your questions like that from an objective point of view. Because I think there's a lot of questions out there. Their deck that was online, that was available, is taken down. Why? I don't know. But it's not there anymore. That presentation that they put together was one of the most impressive presentations I've ever seen online for a deck. It's incredibly ambitious. But it had every incentive you can possibly think of tied to it. Clean energy, you know, marine development, you name it. So there's some questions. But I'm looking forward to meeting with them to get some more answers. Mark, you had a question.
Yeah, what's everybody's guess a year from now where the Fed funds and the 10-year land a year from now?
Ooh.
You guys want a dartboard?
Hang on.
This is
Fed funds, I mean, your 10-year is going to be well north of 2. I mean, certainly you're going to be pushing 3, I think, at that point.
Yeah.
That's my guess, but you'll probably see about a 3. And again, historically, that's not a big number. I mean, you know, when Social Security talked about running out of money, we were using a 5.9% 10-year rate, you know, so Social Security is going to run a lot faster because of that, which side note, not a big deal. But I think you're going to see 3%. I mean, I don't know that's enough to stop the markets because, again, you have to put it in context, right? Like we said earlier, yeah, well, what's the situation today and the environment today for that to matter versus 10, 20, 30 years ago? So I think you're going to see 3%, but I don't think it's going to be the end of the world if you do. So.
I think I could see the Fed, you know, to go back to Eric's comment, I wouldn't be surprised if it starts in quarter increments, and obviously very soon, right, in March, right, early March is the next meeting, middle of March. And then I could, you know, depending upon what the headline looks like, right, on the follow-up, they don't have to wait for meetings. They can do it whenever they want, right? You could easily see them kind of maybe surprise, I think. And if that starts moving like north of 7.5%, 8%, I think you could easily see them decide to go back and start bumping it up. I mean, you could easily see, 5, 6 quarter point moves, maybe with a half point move at some point if they don't get it under control very quickly by the end of the spring. So I could definitely see it sitting, certainly north of 1%, very, very easily by the end of the year. And if they have to, they could go 2.5. I mean, almost overnight, right?
Yeah.
They just, it's a push of a button, right? So I think they'll calibrate it. I think that, and if you read the minutes from the last meeting, unsurprisingly, they carve out an enormous amount of room for themselves to do just that, to surprise. And I actually think reading the markets, my own sense is that the markets may actually already be pricing in to some extent, maybe a little quarter point surprise at some point over the spring.
Yeah. Yeah. You waver back and forth. I would, if I had to put a number on it, I would say somewhere in the range of 2 to 250 on the Fed funds rate, and another 100 basis points on top of it where the 10-year rate is. That would seem like, a fair, things are, that would be an economy where they're tightening, inflation is starting to show some evidence of coming down, the economy isn't really having any major hiccups, so it's still growing well. They're getting to some idea of what neutral funds rate is, but quicker because the inflation is higher than they thought it would, so they have to tighten more than what's priced in right now. So, that would be a sort of copacetic, everything's okay. We can get the funds rate up to 2.5, and the 10-year rate will be 100 basis points on top of that. That would sort of be as close to a Goldilocks scenario as you could probably hope to see.
I think the energy outlook, right, that's gonna drive a lot
Big
of the story,
time.
which is a huge wild card, right?
Yeah.
Gas prices.
Yeah.
Yeah, being the father of a daughter that recently entered the labor market, so $15 an hour or more as a starting job, do you see any resentment in the workforce that's already occurring with those that are already in that position or in a position within the same company?
Oh, good question. There's actually a lot of evidence on this. Labor economists refer to this as like wage bands, right, in the wage force, and so to the extent that you've got folks that are, entry-level folks that are bumped up, that high, generally speaking, for obvious reasons, as you allude to, everyone else gets a little bump up. They might not get as much as they think they deserve vis-a-vis the entry level at $15 an hour. But if you want to keep them around as an employer, I think a lot of folks will probably have to start bumping up. And so there's this. Even when minimum wages are hiked, right? Minimum wage hikes have the same effect. They oftentimes hit multiple people kind of at the bottom end of the wage distribution. So, and this becomes a potential. Back to Richard's point earlier, this is the potential for, kind of some kind of wage spiral in inflation. It's really a function of whether or not, businesses think they can pass these on. These higher input costs or not. I think there's a big gap between the way that corporate America has handled the last 20 months vis-a-vis small businesses, right? For obvious reasons, they don't have the buying power, they don't have the leverage that corporate America does. But I mean, corporate America is just they're flush. I mean, it's like reflected in the stock market, albeit it's been pretty volatile. But I mean, it's like. They're sitting on mountains and mountains of cash. They almost don't know what to do with it at this point.
Yeah, it's actually been kind of remarkable on that so you have these companies that have been forced to raise wages quite a bit. It's not really hitting their stock price because there's usually just a tension between, okay, we have workers we have to pay, so are we paying more of our income to the workers, which lowers our profits? Or are we getting more of the profits and squeezing the worker, which means rising profits, rising stock price, all that. You have just a lot of pricing power amongst companies. It doesn't look like their profit margins are getting squeezed. They're able to raise workers' wages and keep their profit margins. So I think that's kind of true of a lot of companies. Like right now we're in an area of there's pricing power. And so you can push on prior prices, you can pay people more and still keep your margins kind of steady. Will that continue? I don't know. But, in terms of, look, I'm of the school where people take a wage because there's a benefit on both sides, right? So there's a benefit to the company and there's a benefit to the worker. So the good news is that in this kind of a labor market where there's many more jobs that exist at that wage level or higher, it'll probably bid up wages continually because people will move around. What's the difference? I can take this $15 job, or I can take this one that'll give me better benefits or whatever it is, or more flexibility. I'll take that one, and then someone's got to, well, okay, maybe I have to pay $16, $17. So, so there is that dynamic going on right now where I think wages at the low end will continue to be bid up. And, so people certainly show the desire to have, to enforce that power that they've now have. Yeah. And so that I think that wages at the low end especially will probably rise quite a bit more than what they already have.
One more last question. Celeste.
Yes, I see, coming back to the small businesses, our workers have become entrepreneurs and investors. With that federal money or that government money, I see a lot of small businesses being developed and all that. Mm-hmm. So what I see is the key in here is to build a stronger community, to grow a stronger, sustainable economy. The city of Pleasantville, for example, have a Latino mostly population that is growing small businesses. And Pleasantville have the highest housing ownership in the county.
Yep.
So that money has been invested. So we can learn from them and take that and build our economy. Mm-hmm. Because I see that is the key right now. So they're no workers anymore. They have become entrepreneurs, like I said, and investors. Yep. And because it's the resident of Atlantic County, that's big, because it's nobody else coming from outside, investing, and just renting. This is ownership. That has meant a lot to our tax base and our economy. So what do you think?
Yeah, I mean, I think that kind of organic kind of, grassroots growth is obviously key. It's tends to be, if you think back to the early development discussion about, subsidizing and landing, whales, big whales of attracting, there's different approaches to doing it. And I think oftentimes kind of a diversity of approaches works well, and that's certainly, building at the grassroots, community organized businesses, small businesses, should be an important part of it. They oftentimes are far more invested for obvious reasons in the communities. The profits aren't, sent elsewhere. They remain and circle within a community. Getting businesses, those kinds of businesses, to scale so that they actually can compete is an important part of it, and that's oftentimes, I think, the most challenging part of it. In many cases, those kinds of businesses operate with very, very, oftentimes very thin margins, and their capital is oftentimes a big question. And again, that's kind of where the state can play an important role in incubating, right, those kinds of smaller oriented businesses, for sure.
Yeah.
Important part of the story of diversification.
Absolutely. Yeah. Yeah, it's wonderful, right? I mean, that's what you want. You want people to own, right? I mean, you want people to have, there's a real economic benefit that people own the assets and, have a stake in their community. I mean, that's a lot of ways, it's the way America has grown is that immigrants coming in, moving into an area, creating communities where they can, benefit from one another. The economic benefits of a community, a strong community, are huge, right? I mean, you grow together, you're invested in the area, and that's a lot of the dream, right? I mean, that's a lot of where the huge benefits to everybody comes from. It's from owning and investing in a community. Definitely, the access to credit has been an issue for forever, right? So, there were credit. I'd actually, you should probably look at the Federal Reserve. They have a small business credit report, and they talk about access to credit and how it's differentiated between, different minorities versus, whites, and And there's no doubt. I mean, it makes a huge difference just having access to credit, because the way it's worked historically in these types of communities is that the money to invest in the businesses comes from people's pockets. And that's not the way it should work, right? I mean, you have a business, and the business in some way should be separated from you. And if you have an idea of how to grow it, you want a bank, that's what banks are there for, to help you borrow money to invest and grow your business. And the access to credit has been much more limited for minority owners historically. So that's a real speed limit on your ability to grow businesses in some of these communities. And so, it's a focus here, right? I mean, there's definitely a big focus. I've worked on some of this too, just trying to understand where those gaps are. Now we're trying to get some of the banks to meet with us and say, okay, the community says that they see these lacks of access to credit. What are you doing, right? How are you providing credit to these people? Because some of it has to do with, the amount of collateral they have. Some of it is just sort of like the relationships, right, with banks. So establishing those relationships with banks, being parts of a chamber that can, give you that power, those are huge things. But I mean, in general, it's a great thing that, you have a growing community of people who really want to invest in the area. But getting that access to capital so that not that everybody wants to grow their business, double their business. Some people, nothing wrong with having a good, sustainable business that is, but people who do want to grow their businesses, having that access to capital is so important, and making sure that you're part of like a bigger power system to get your word out, to make sure that the banks are giving you the capital that you need, that you're getting your fair share and you're being heard, is so important for that to keep it going.
No, I certainly appreciate. I want to thank our panelists, Oliver, Rich, Eric. Awesome job today. Thank you so much. Again, our sponsors, we can't do these events without our sponsors, with our partners. Stockton University, Rich Asset Management, Ocean Wind Horizon, Comcast, and Atlantic City Electric. So just a couple upcoming events that are coming up. March 4th, we'll be right back in this room for a casino leadership panel. 4 or 5 casino executives will be participating. There are very few seats remaining for that. I know that's going to fill up pretty quickly. It's always popular. We're going to do another one back here on April 8th. Talking about clean energy with some of our utility partners, what that means to our destination, some resiliency conversations. May 17th is our annual Business Excellence Awards. Very different style this year. We're not doing seated tables where everybody sits with everybody they know. It's cocktail reception, high end, get in front of people you haven't seen in a long time. It's going to be a lot of fun at resorts. And then June 1st is our annual meeting of membership luncheon. We're going to be talking about we're working right now on a 5-year strategic plan. So much has changed through the pandemic that we needed to take a hard look at our organization and what we're doing. We'll be talking about that on June 1st, but it's a great luncheon out at Seaview. And I think that is it. This is contact information. You can follow us on social media. My name's Michael. I'm the president of the organization. Anything you need, feel free to ask me. But thank you for coming, and thank you again for our panelists. Greatly appreciate it.
Thank you. Thank you very much.